And welcome to the £5 Challenge. This is where we invest £5 a week into individual stocks which the community on the Sensible Investors Forum can pick, or it's just random ones I find on the market. This is where I can break it down to you and you can find out how you can research and how you can get into investing with just £5 a week. Welcome to the £5 Challenge. This week we're talking about the Renewables Investment Group, ticker symbol TRIG. TRIG Group has an independent board of non-executive directors who oversee the TRIG's investment manager, Infrared Capital Partners, TRIG's operational manager, and Renewable Energy Systems, who provide the day-to-day management of the company and investment portfolio. As of February 2020, TRIG had a portfolio of 70 renewable energy infrastructure projects across the UK, Ireland, France, Germany, and Sweden. Currently, it has 77 total projects, with onshore wind accounting for 43, with solar accounting for 28 of these projects. Portfolio by sector shows that onshore accounts for 55%, with offshore wind following with 35%. It is a FTSE 250 investment company, primarily doing renewable energy. This is where we can really see the numbers being broken down. They have a total net capacity of 1,820 megawatts, with onshore wind accounting for 1,210 megawatts of this. So we can really see how much energy they're producing just by onshore. Now, if you just take a look at the portfolio by country, we can see Scotland is leading by a third. This is where they put the majority of their money into it. And we oversee battery and solar panel only takes up a small portion compared to the on and offshore wind. Now, when we're evaluating stocks, what we normally like to look at is the PE ratio and the PEG ratio. So we can see here it has a PE ratio of 21.9, but that is not an accurate way of looking at whether this stock, well, fund in this case, is under or overvalued. What we need to do is look at the NAV compared to the stock price. So the NAV is net asset value of how many assets it has within this fund and how much we're paying for it. So if we go and take a quick look here, we can see the estimated and the last net asset value was 114 pence 0.38. Now if we take a look at the stock price, the current buy is here at 127.20. So we're actually looking at a premium of almost 10%. So this is how much you're paying more than the assets available. So breaking it down here, this is actually, it's quite an expensive stock compared to the price. Now, when we like to buy stocks, we'd like to try and outperform the market. Now, as we can see here, over the last year to date, so that's over the last 52 weeks, it's actually returned 0.11, well, minus 0.11. So we've got a negative return. Now, if we look at the 1 year chart, we've only just made a small return of 0.2%. If you compare this to the S&P 500, over the last year to date, it's returned 12.27. Over the last year, 41.02. There's a huge difference there. But now let's just have a see here of their gross margins and returns on assets. So since 2019, there's been quite a dip, as you can see up here. It's fell by 18.17% over the last year. That's just because of the type of year last year we've had. It's been quite difficult, but gross margin here 99.83%, net profit margin 84%, and operating margin is 98%. These are incredibly high because of the way funds work. There is no true overheads because they're investing into these projects. So we're obviously going to see very high margins as we've only got a board of directors overlooking it. Now, return on assets, equity and investments, these are all currently at 4.91%. It is what it is. It's an investment fund, so we are not going to see a huge amount of return on these because it is incrementally put back to us, and that's how they make the cash through the cash flow of their investments. Currently, even though TRIG is actually trading at a premium to the NAV, it's actually kicking out a 5.3% dividend yield and a 58% payout ratio. This is actually very attractive. This actually looks quite healthy. So even if we see the NAV be brought close, well, the stock price could be put closer to the NAV, so it's trading at less of a premium, we can actually see the dividend yield actually go up even further. Now, they have been actually increasing the dividend, though it's only a small amount, as we can see here. So in June 2020, they actually increased it by 0.03 pence per share. And back in 2019, they raised it again. Hopefully we can see another raise, especially with the payout ratio being so low. And they've actually been able to reduce it. So if we just take a look back to here, so in 2016, the payout ratio was 71%. Then in 2019, 58. So that's the way we like to go. We like to see they've reduced the payout ratio. That gives us more of a margin on our dividends and such a good yield. This is actually how we have returns given back to us from this company. Isn't there for growth usually. It's there for renewables, buying renewables, and that steady income through the dividends. Just want to point out there's also a quarterly paying stock, so we can see here it pays out in March, June, September and December, so 4 times a year. It's quite a nice dividend. Some other fundamentals I want to go over is with funds like this is a closed-end fund, we have extra charges. So these are called ongoing charges. With these funds, because they're actively managed, we find it here, and this is charging us 0.94%. So this is quite high, especially if you compare it to ETFs such as VWRL, which is a Vanguard All-World ETF, that only charges 0.22%. It's because we normally find ETFs are passively managed compared to these funds which are actively. So you've got to pay for the overhead. So this is what we're paying for managers to actively manage the investments, try and pick, maybe beat the market, or some other kind of goal like this TRIG and other ones such as it is income generating funds. So they've got their own goals. You're not going to beat the market because that is not the purpose of them. We can tell TRIG's got a good management, as we can see here through the investments made through 2013 to 2020. They've had a record year in 2020 with £588 million invested into new projects, just the same as 2019 with 508 million. This is great that they can push forward their company so much and really try and invest for the future. Moving on to news. In December 2020, TRIG has actually done something the first of its kind in this area. It secured £500 million worth of revolving credit facility, but linked to their ESG. So with renewables, it's very ESG correlated. And what they've done is that the more social and economically viable and well this company performs, the more or better rates they'll be able to get on this loan. And it's the first time that such a company or in this sector has managed to do such a thing. In January 2021, TRIG has actually found another investment opportunity. So with the Beatrice Offshore wind farm, which is located on the northeast coast of Scotland, they've acquired a percentage of 35% of the wind farm. We see here it's worth 588 megawatts, and it's made by SSE, and it's got 84 Siemens 7 megawatt turbines. So that's a lot of power that they got on that site. So you can see here they've teamed up with Copenhagen Infrastructure Partners, and this is a very good move. What we like to see is acquisitions and moves, especially the way that TRIG can actually go in and out is they can take small stakes in lots of different projects and spread their risk. In March, TRIG actually raised £240 million. It's worth to finance it because of the acquisition of that Beatrice offshore wind farm. They used that credit facility that we talked about earlier. So raising this capital paid down the amount of they used for that. And that's a good sign, because what you like to have is a very healthy credit facility. They actually have no debt anymore because they all paid it off. So having it there means that they can leverage themselves more and move around the market and get these opportunities when they arise. I think what we can see is that TRIG is actually doing really well with the amount it's investing over the last few years, and the fact that it's got ESG linked credit facility, which is actually really quite nice, and it's leading its market in such a way. but I don't think we could ignore the NAV and currently paying such a premium for the stock, which is almost 10%. That's quite a lot. And I think it's going to come into some headwinds, especially when you take into the fact that all these oil majors such as BP and Royal Dutch Shell are coming into the market. Now this could be a double-edged sword really when thinking about it, because it could create more fierce competition for such a fund and others of like, but then we also have that it can push down the prices of creating such like investment opportunities or these wind farms and solar farms. It may also reduce the price of such electricity, reducing the profit margins of the company. So it's something we definitely got to look out for. I just think with the NAV being so high and the risks or potential risks coming into the market, we haven't got much of a safety room, and really I'd like to see much less of a premium. And we've also got to consider the ongoing charges at almost 1%. That's quite high, especially if we compare it to ETFs. And I know this is a very good way of having a good income. As we can see, a 5% yield with a very healthy payout ratio. If you want a dividend income, then it looks quite attractive, especially if we can get out more of a discount compared to where it is at the moment. But I think at current prices, it is not one to be adding into the portfolio, and I would wait to see how far it can come down and see in the future. Just want to say thank you for watching this video. If you want to see the write-up and all of the links, you can go to sensibleinvestors.co.uk and find the rest. Please leave a thumbs up and subscribe to the channel to have see next week's stock. Thank you very much.